Everyone, we are going to go ahead and get started. I want to start by saying thank you so much. Thank you so much for being here. It means the world to us. I am your host, Eric Thompson. I'm with Windermere Real Estate here in Colorado. That is our very special guest, our keynote speaker. You can see Matthew Gardner there. Say hello, Matthew.
Hi, guys. How is everyone?
Terrific. Thank you, Matthew. So I am at my home in Fort Collins, Colorado. Matthew's at his home in Seattle. This is our annual real estate market forecast. So what we hope all of you are happy and healthy and safe right now. We so appreciate you joining us here today. The plan is we have blocked out an hour and a half. We have an hour for Matthew's presentation, and we have time blocked out at the end for your questions. We're happy to take your questions at the end. Speaking of questions, how about we do just a quick practice on how to type in a question. This will also give us a chance to make sure that you can hear us okay. This is a chance to do a sound check. If you wouldn't mind just typing in the chat that you can hear us loud and clear, that we're coming through crystal clear for you, that would be super helpful. Great, I can hear, or I can see lots of nice comments coming in. We have a lot of people who are engaging with us today. We had hundreds and hundreds and hundreds of people who registered for today's webinar. We know a lot of you will be watching the recording as well. So whether you're watching live or watching the recording, we appreciate you being here. You're going to get a whole lot of takeaways from Matthew about the market. Matthew is one of just a great asset for us here at Windermere Real Estate. He's our chief economist. And what you're accustomed to is seeing him live every year. So typically what we do is we have 2 live events, one in Denver, then the next evening in Fort Collins. We typically have around 200 in Denver and around 500 in Fort Collins. Well, obviously this year we can't do that. We still wanted, though, to be committed to great content, great information for you so that you can get a whole lot of clarity on what's happening in the market, so that you can make sense of some pretty significant things that we see happening in the market today. I want to tell you to please stay until the end, all right? Please stay until the end, because I will share with you some resources that are available to you as a friend and client of Windermere Real Estate, some other education and content you can engage with that we think will help you even more. So make sure you stay until the end. Again, we have blocked out an hour and a half. That is the plan. So as we go along, again, if you have questions, feel free to type those in. I'll be watching the questions as Matthew is talking. We're going to save the questions, though, until the end. So Matthew will complete this presentation and we'll do questions at the end. All right, that's the plan. Sound good, everyone? Fantastic. So with that, I would like to introduce our very special guest, our keynote speaker. It's Matthew Gardner. He is Windermere Real Estate's chief economist. We are the only real estate brokerage in the country with a chief economist. Matthew is pretty humble. He won't tell you these things himself. He's often quoted in the news, in publications. You'll see him on CNBC. He gets quoted in industry publications. He's really known as one of the thought leaders in our industry, one of the go-to, one of the most trusted economists in the real estate space. And we are so blessed to have him in our company. We're so blessed to have him here today. Matthew, I'll turn it over to you. Thank you so much for having this presentation again for us here in 2021. The floor is yours. Take it away, my friend.
Thank you, Eric, and thank you all of you for showing up today. I know what's happened, obviously, since COVID and through the course of almost the whole of last year. I think a lot of us are getting what's called Zoom fatigue, or at least fatigue on how we are interacting with other people and having events now like this. As Eric mentioned, I'm so used to coming over to see you guys in person. I do look forward to doing that again, fingers crossed next year. But you know, this is what it is. For those of you that have seen me speak before, you know I like to take a top to bottom approach. And that means we'll start looking at the US economy briefly, what's going on there, what's going on in the US housing market, and then we'll distill it down into Colorado and the region. We're looking both obviously at the economy and what's going on there, and ultimately housing. Now, Eric was very kind enough to give me a little bit more time this year than I normally do. So we're going to dig in just a little bit deeper into the representative counties in Colorado that we have a presence in. So that said, let us get going. This is a different world in which we live, and it has created a lot of issues for us economists because of uncertainty. Now, if you look at new COVID-19 cases daily, it's jumped. We've had really back in end of last fall, we jumped above 100,000. Now we are averaging over 200,000 new cases per day. And this has an impact, and it has an impact on the economy, which is very, very significant. I'm hopeful this will start turning around, but I'll talk more about that in a few moments. So, big picture of the economy. How we define growth in the economy and how well we're performing based upon GDP, gross domestic product, the value of goods and services that we create. Q2 of last year, we saw the biggest contraction ever. Yet in Q3, we saw the biggest expansion ever. Now you can say, well, this is great, isn't it? Doesn't it mean we're back where we are? Well, not quite. That 33.4% we saw in Q3, to get us back to where we were in the spring, would have to be above 45%. So we're still a ways away. However, as we go through the balance of this year, and you see here my forecast for the fourth quarter of last year, numbers aren't out yet, but you can clearly see it is going to pull back. It will still be above that long-term average of roughly 2.5%. But one thing you'll notice is that we start seeing some increase in the second half of the year. And that is going to be important. And what's going to drive that? What's going to drive it, hopefully, is going to be a free and wide distribution of a vaccine. Point one and point two is, are we all going to take it? If we get it out, if we take it, I do expect the second half of the year economically to be far better than the first. In terms of employment, this is monthly employment gains for the country. Massive contraction. We started seeing growth again as we came out of the initial phase of COVID. But you can see here last month in December, we actually lost jobs, 140,000. What was going on there? Well, it was basically leisure and hospitality. It was hotels, bars, and restaurants. That is a sector that we have seen the greatest drop in employment, and it is going to be a laggard going forward. Why? Because of COVID-19, and it's going to be wholly dependent on us going back out again to bars, restaurants, and also us traveling again. So it is acting as a fairly significant weight. But to give you an idea of what actually happened, I went back to the fall of 2010 and looked at job numbers and cumulative job gains. We added a bit more than 22 million jobs, fall of 2010 to early 2020. We lost more than that number of jobs in just 2 months. Really quite extraordinary. But you can see the spring back we saw. Certainly we started to see a lot of jobs coming back in the early summer, but that obviously has now faded. I do expect to see jobs come back again this year, but again, the growth is going to be in the second half. Now, these numbers here to give you an idea of what's going on. The 340 for Q1, that is the average monthly gain in the quarter. So we should average about 340,000 jobs per month in that quarter. So again, the expansion is going to be in the second half. So we just need to be a little bit more patient. From the unemployment perspective, 6.7% in December, that is pretty much a number which I had anticipated, but that's the headline number. But a better number that I tend to track, as all economists do, is the 11.7. That's the real unemployment rate. That includes people who are out of work, but who aren't actively looking for work. It is getting better. Back in April, for example, we were at about 23.5%. We haven't seen that number since the Great Depression. So we really are setting all manner of rather bad records all over the place. But it is getting better, and I do expect that we will see that improvement continue. However, we are not going to get back to that sub 4%, 3.4, 3.5 that we saw in the early part of last year. We won't see it this year. We are likely going to see it next year. But the trend is still going to be heading the right direction. From a housing perspective, we know that the economy is almost stuck. Again, it's really waiting for that vaccine to come out, and that's holding back the economy. However, as far as the housing market is concerned, we really are doing spectacularly better. The trouble is, there's nothing to buy. This is the number of homes available in America today, of existing homes, 1.4 million. I mean, it's over 1 million shy of the long-term average. And my long-term average goes back to 1968. So very, very low levels of inventory. I think, however, we are going to see that start to notch up a little bit for reasons I'll get to momentarily. It is so tight. This is how tight the market is. For every home that was where a contract was written in November, there were 3.3 offers. It is still very staunchly a home seller's market. Very competitive because we have significantly more demand than we have supply. Home prices, because of a lack of supply. I want you to think back to your economics 501 classes you took back in the day. When you limit supply and you have net new demand, what happens to prices? They go up, and they rose significantly. You can see here significant slowdown in May because of COVID-19, but the bounce back, the V-shaped recovery we've seen is very palpable. Now, we did see a slight pullback in November. It's still, however, well above the long-term average. But I do, however, expect sales to increase this year. And you might say, well, hang on, if there's no supply and all this demand, how can sales grow? I think a lot more of us are going to move this year. And mainly, well, it's going to be because of COVID-19. For a lot of people who are now, like myself, and many others, I'm sure, working from our homes, that will allow some people to say, you know what, I think I can move out to a cheaper area, I can get more house. Also applies to renters as well. They can move further away to cheaper rental markets, or, as I anticipate, we'll see a lot of those renters become home buyers. And one final thing, well, what do we do when we look at anything too frequently? I've sat at my dining room table now for 10 months working, and I'm looking at the same four walls. We get bored. And what happens when we get bored? Well, we just say, I don't really think my living room is big enough, or my kitchen isn't. And I think I expect to see more turnover because of people moving purely because of the fact they're bored with their own homes. So we are going to see sales grow. They're going to grow. They're going to rise rather to a level we haven't seen since 2006. But the downside of that is we are going to see home price growth slow. Haven't got December numbers yet, so it's still my forecast for 2020, 7.5%, really very robust. Only beaten in 2013, and that was as we were coming out of the bursting of the housing bubble. But it is going to slide back down, and I am totally fine with that. And the reason being we've seen, well, that we saw home prices increase so spectacularly last year was because of mortgage rates. As mortgage rates dropped, they dropped by almost 1 percentage point in the space of 1 year. That allows people to buy more homes. For every 1 percentage point drop in mortgage rates, a buyer can qualify to pay 10% more for a home than if those rates didn't go down. But home price growth will slow, and again, I'm fine with it. But another reason why home price growth will slow, it's not for the fact that just because of mortgage rates, which I'm about to talk about, but as we see more supply come in the market, and I also anticipate the new home market to improve as well this year, that is going to allow more supply, that softens prices, but also it's this. Mortgage rates. So if we look at mortgage rates, this is the weekly rate for 3 different types of mortgages, going back from when the pandemic started. A couple of things here. One, you can clearly see that massive spike that occurred, and it occurred last week. What was going on there? It's really rather simple. It was the Georgia Senate elections. When the Democrats won, we actually saw a massive move away from bonds, from treasury bills and into the equity markets. As many of you I'm sure know, that mortgage rates track the yield on 10-year treasuries, certainly 30-year fixed rates do. And because of that moving out, less demand, that means the interest rate's got to be higher for treasuries. That is allowing mortgage rates to rise. But don't worry, actually there's one other thing I do want to mention. Look at the ARMs, the adjustable rate mortgage. The relative advantage of an ARM over a fixed rate mortgage, it doesn't exist anymore. Very, very unusual. My forecast for mortgage rates, gradual ticking up. And that again will act as a bit of a headwind to home price growth. But really don't worry, I think we'll end the year around just shy of 3.1%. So a gradual slowing into a gradual increase in mortgage rates, but really not that bad. But if you don't believe me, I meet with a lot of friends of mine and they are economists across the country. We have a weekly conference call, and this is their forecast for mortgage rates, including my own. We always laugh at our friends at Fannie Mae because they're down at 2.8, very, very bullish. Don't see it myself. And even Wells Fargo is below 3. Mortgage bankers, well, they are pessimists, but even they are looking at just 3.3%. So do expect mortgage rates to rise, but the increase will be modest. It will act as a bit of a headwind to price growth, but it's still going to remain very attractive. Think about it this way. Back in 1982, where were mortgage rates? That's right, 18% plus points, 20% mortgages. We still bought houses. So as much as we are going to see a very slight and very modest increase, it is still going to be, although not historically low, very, very low, relatively speaking. A lot of people ask me about forbearance. Certainly a lot of our agents do. And the big concern out there is the fact that the program, which was implemented back in the spring by the FHFA, by the way, I think that was a very, very smart move to do, allows people to postpone making their mortgage payments, but not go into foreclosure. Well, the numbers are down now by 43% from the peak we saw in May. They're still stable. We know that the GSEs, Fannie and Freddie, have extended forbearance through March, and it wouldn't surprise me to see them extended a bit further. But the bigger point is this. A lot of people thought that when we saw that forbearance end, people will still not be able to make up those missed payments or indeed carry on with their mortgage payments. They'll go into foreclosure. We would then see a veritable tsunami of homes entering foreclosure, more supply, and that is going to allow home prices to drop or cause them to drop significantly. Don't see it happening. And for actually two big reasons. One of which is I think the banks are going to work a lot more with borrowers. They're going to be able to refinance. They'll be able to extend the term of their mortgage. And if they do that, again, that's going to keep them in their homes. Banks want people to stay in their homes this time around. Lessons learned from 2009. But I'd also say this, is that if people, and there will be some, unfortunately, that cannot make or continue to make their payments because they still have been laid off from their jobs, perhaps, well, they're going to sell. And they're going to sell because 80% of homeowners in forbearance have more than 20% equity. Now, we know there's a lot of demand out there, and that's a great thing. So I think if they sell, that means they're not going to go into foreclosure. And I think ultimately, although foreclosure rates will rise, my forecast is for roughly 500,000 this year. That's still, in essence, along the long-term average. So forbearance is okay, and we're not going to see that flood of foreclosed homes. On the new home market, we're actually seeing more new construction activity. Permit levels in November annualized jumped significantly. What's happening there is builders realize there's a lot of pent-up demand, but more importantly, they're now looking at markets further out because of the ability to work from home. And as we see more permits, that's good, and it is much needed because the number of homes for sale, new homes in America, again, it is woefully inadequate. But if we start seeing more permits, that's going to be good because it has already had a negative impact on sales. But we are going to see a lot more new construction activity going on through the course of this year. That's going to mean more supply. And it will also be another reason why we will see sales prices of existing homes soften somewhat. My forecast is we'll probably have about 1 million transactions of new homes this year. Massive number. One we haven't seen again since before the bursting of the housing bubble. So ultimately for the housing market, demographics still very good. A lot of first-time buyers and a lot of people choosing to move. Mortgage rates, yes, they are rising modestly, but they are still very, very favorable. New construction will rise. That will take some of the price pressures off. And because of that, price growth will slow. First-time buyers, talk more about those guys locally in a moment. But we'll see a lot of demand from first-time buyers, not just, well, we were going to get a lot of demand anyway. But again, the ability to work from home is going to mean some renters will become buyers. And so I think we'll see actually a pulling forward of some of that first-time buyer demand. But most importantly, it is going to be because, well, potentially we'll see even more demand because of the Biden administration's proposal for a new $15,000 first-time buyer tax credit. Now, I don't know whether that's actually going to be enacted into law. If it does, again, that is going to mean we will see even more demand from those first-time buyers, and a lot of those are from renters. I mentioned here my final point, the move to the suburbs is real, and it is, but I would just caution you about that. A lot of people have presumed that we'll leave all our cities and we're going to go disappearing off into the wild blue yonder. I don't see that happening. And here's why. I think the work from home paradigm is real. It's not going to go away. It'll be around for a long time, if not forever. But I also believe that we're not going to be working from home permanently. We will be splitting our time between our offices and our homes, 2 or 3 days at home or 2 or 3 days in the office. And because of that, we're not going to move that far away. And certainly in some markets, and as Eric mentioned, I'm here in Seattle, there's a value to our time. We choose to live, or we will pay more to live closer to where we need to be. If that goes away because of work from home, well, then we'll move further out. We'll put up with a lousy commute maybe, but if it's only for a couple of days a week, it will still happen. And what's interesting is some of the top ways that COVID has impacted our decisions to move. And this is a study done by Unit Group a while ago. Number one, well-being, our health. Secondly, the possibility, or it will allow some of us to move closer to our relatives, to our family. Changing work arrangements. Number three, actually, although still 57%, again, it's going to be a big driver of new demand. And lifestyle, quality of life, well, that tends to speak to the fact of moving out of our urban markets into the suburbs or further out. So COVID-19 has had a very significant impact on housing demand and on the choices we make when we're thinking about moving. Okay, so that's national. The economy nationally is going to do better in the second half of the year than the first. I'm hopeful also that we could see the Biden administration implement some new spending programs, mainly around infrastructure. Again, we have a lot of roads, a lot of bridges that are in need of repair or replacement. The trouble is now we've got these massive budget shortfalls, massive national debt levels. Will there be the political will to do it? Maybe there will. I'm fingers crossed in that respect. But the second half of 2021 will be better than the first. As far as US housing goes, as I talked about, a good market, softening price growth, more demand. Locally, and I apologize this slide, I went onto the your state's website to try and pull the data, and it doesn't seem to like to let you do that. But to give you an idea of new COVID-19 cases in Colorado, saw that spike, pull back down, saw it go up again, but we have seen some softening. So congratulations to all of you. Keep masking up and keep social distancing. It's going to be very, very important, not just across the country, but certainly in Colorado, that will allow you, hopefully, to see the economy improve. Employment. This is my state-by-state forecast. Again, we haven't got December numbers yet for the Western United States. I expect Colorado's employment growth to have dropped by 4.2%. Not as bad as California, not as bad as Hawaii, which is obviously massively impacted because of tourism. So you're actually doing a little bit better than most larger markets, but it is still a significant contraction. Yet as we go forward, I expect that we will see economic growth drive more jobs. I also think in the second half of the year, we'll see more, mainly because we'll feel more comfortable going out in public. And what's happened is we have not been spending our money in the way we normally would. And our cash is burning a hole in our pockets. As we feel comfortable going out, we'll start spending money. That's going to be an economic driver. That's going to start creating more jobs. Job losses because of COVID. And these are job losses, by the way, on the left between February and April, and the jobs recovered. I mean, Denver, over 182,000, but you've got 124,000 of those back. So we are seeing a recovery. It's not balanced, obviously. Boulder is still suffering. So you can clearly see here, all markets are not created equal, but all of them are, however, still starting to show some return in employment. And my forecast is, I will see the Denver metro area, about 37,000 new jobs, Colorado Springs second at 6,600. So it will, in essence, across the board, be an improvement, but no market is going to get back to where employment levels were earlier on in the spring this year. It more than likely will be next year. But of course, the uncertainty is out there, which is going to be driven by COVID and by vaccinations and our ability to get them and also our desire to take them. On the unemployment side, massive contraction again. You clearly saw back the peak in April, very, very high double digits in all markets other than Boulder, but it has pulled back, and Fort Collins and Boulder are down around that 5% level. It's still, full employment's considered somewhere around 4.5%. So getting closer. but a palpable improvement across the board. So regionally, yeah, uncertainty. My liver is killing me because of the fact that when we look to forecast anything, certainly when it comes to the economy, we want predictability. And that is just what we don't have right now. So I am presuming in all my forecasts that we are going to get a vaccine, we're going to take it, we're going to get it in our arms, most of us likely in the late spring, early summer of this year. Presuming that will be the case, again, I expect the economy regionally to continue to grow. Pace across the state has slowed, and that's similar to the national numbers as well. We have seen that slow down, and most of that came with the third peak that started in the fall of last year. Trade is going to be a big player in terms of new jobs, professional business services, utilities, and finance. I also naturally think that education and health services will also do well for the obvious reasons. So we are going to see most sectors do okay. Some will still be outperforming. And the good thing about that is that they are fairly significant numbers in your market. Same as the nation, will pick up speed in the second half of the year. Okay, now this is the important part that I'm sure all of you have been waiting for. Regional economy is recovering slowly. What's going on with housing? I'm going to start out just with the Case-Shiller numbers. For those of you that aren't familiar with them, Case-Shiller is an index that was put together back in the 1980s, long time ago, by somebody called Case and somebody else called Shiller. And what it was, it's a repeat sales index. So rather than just looking at the value of transactions over a certain period, a month or a quarter or a year, it looks at the sale of the same house over time. So if you bought your house in 2010, sold it in 2020, they calculate what the spread is between your purchase and your sale price. That gets built in to the index. So it's actually a very good way of looking at housing and looking at housing values. Denver, 7%, pretty darn good. Here in Seattle, we're still outperforming, which is, for me, in my opinion, somewhat troubling because of affordability issues. We're second to Phoenix, which is still recovering, quite frankly, from what happened with the bursting of the housing bubble. But significant growth, really, well above the long-term rates across the board. And so Denver's doing well. And if we look at the different component cities, you see Detroit hit there. It is one of the cities, doesn't have a number because they've got some ongoing COVID-19 related reporting issues. But if you look at your change from peak, who's number one? You guys in Denver. And we are number 3 here in Seattle. And so significant growth. However, there are still, as you can see, some markets, including Phoenix, that are still not above their pre-recession bubble. So New York, Phoenix, Miami, Chicago, and Vegas. Vegas will continue to suffer for the obvious reasons of the fact that the hospitality industry is massive there. Now, that last column, you see the change of momentum. That looks at the percentage growth over the last 12 months compared to the 12 months beforehand. So it's a good idea to see if you are still expanding compared to where we saw it a year ago. And you certainly are, and we are across the board. A lot of demand, but there are still some markets which are still going to take a while to get back to where they need to be. Millennials, I mentioned first-time buyers. They are an important part of the housing market nationally and locally. And what I did is I looked at the share of homes that were sold to millennials. And this share, by the way, is the share of households buying homes using conventional financing, not jumbo financing. Half of your sales in the first 11 months of the year in Fort Collins, almost 60% in Denver. And I mentioned earlier this move away. What is interesting is that I took a look at the top 50 metro areas in the country and saw and sales in 2020 and trying to figure out, okay, well, how many of these people were moving out as opposed to moving in? Well, moving out across those metros, it was about 2.3%. That is up from 2019, but marginally in 2019, it was only 1.9. However, in Denver, which is one of the larger markets, we actually saw growth into the metro area. So again, the belief that we're going to disappear off into the middle of nowhere is overstated. People will move, but they're still going to stay in those metro areas, a lot of them. Now, we're not seeing that in San Francisco. We're not seeing it in New York. We're not seeing it in Boston. So it is a little bit different when we look at it locally. So we have a lot of demand from millennials that is going to continue to grow. Again, they're not going to head off into the mountains. They are going to buy it, and they're going to be a big player in the market. Because Denver is one of the markets where we pull enough data, I thought it'd be interesting just to touch on who these people are. Well, 51% of people getting mortgages were male, 31 female. I know that doesn't make 100, but that is the world in which we live these days. 40%, less than half are married. This is interesting. It's a far higher number. It's about 55% here in Seattle. So a bit less than half were married. They were young. Remember, the oldest millennial, well, they are 39 years old now. They were 31 and a half. We haven't seen that peak, by the way. The peak number of millennials turning 30, generally speaking, that's when you start thinking about real relationships and marriages and kids and the things. That's actually going to hit next year. So we're still going to see a significant number, not just this year, but going forward, of millennials buying houses. They borrowed about $376,000. They bought a house worth, on average, just shy of $460,000. So they're out there. They put down 16%. They are still going to the bank of mum and dad, approximately 50%. Others, however, are squirreling money away where they can and buying. Almost 70% of millennials believe that buying a home will be the most astute financial investment they will ever make. However, qualifying, getting a down payment is a big problem for them. And certainly in these very expensive markets where first-time buyer affordability is very lackluster. If, hopefully there are maybe some builders on this call, if you are able to build homes that first-time buyers, one, can afford, and two, want, then I think you're going to do remarkably well. Oh, by the way, what do they want? They want dog showers. Yeah, I meant it. So I think there's a lot of demand, a lot of pent-up demand, but will they be able to find somewhere that they can afford to buy? But the final part is this: they've got credit, and they started getting credit a lot younger than our generation did, mainly because, and I can cite two of my eldest sons for this, when they went off to college, gave them American Express card, woe betide the child that doesn't make the payment, but they started to build up that credit a lot earlier than previous generations. Now, the markets we'll be talking about, there's several counties which we're going to be going through in the course of the second half of my discussion. But to start out with, let's look at building permits. Not enough. Now, Weld County, I will just add this: Weld County is the only county here that only reports new building permit activity annually. So I had to take 2019, not 2020. But other than that, they report monthly. And so year to date, we are still well below the levels we saw before the housing bubble burst. So going up from 2000 to 2006. Now, that was obviously a very bullish time. We were throwing up sticks and bricks, builders were. So it's unsurprising to see that level drop. But we have certainly seen decent improvement across the board in most of the counties that we'll be talking about. All right, number one, Adams. And these can be similar charts across all these areas, but I think it's important to look at them a little bit more granularly. But a lot of the activity is similar. Listings, horrendously low. And I take the numbers and seasonally adjust them. And the reason for that is if we don't, it kind of looks like a sine curve on my heartbeat. So it kind of softens that out. However, transactions are still, and have been for several years now, well above that long-term average. So a lot of demand's going on there. And sales prices have continued to rise year over year. Sale price growth 14%, very impressive. But we have seen, as you can see on the top chart, some softening there. And this will be applicable in many of the slides I'm going to show you. We're starting to get, in some areas, into an affordability issue. And we look at the fact, as I mentioned earlier, of mortgage rates not rising dramatically, but starting to slowly notch up. That is going to start to have a bit of an impact. On the new construction side, a lot of development occurring. Clearly see massive demand. It is there. Sales are ticking up. And I expect that is going to continue also as we move through this year, presuming we start to see more listing activity occur. It's been on the drop last year. Hopefully that will pick up this year. One thing I would say about new construction, and the belief it is going to increase, and that is true, but it is still very expensive. Now, if builders look further out where land can be cheaper, that is certainly a positive. However, the impacts are not just based upon land price or availability. It's on labor. Not enough people are going into the construction industry. That pushes up labor prices. Material prices continue to escalate. Softwood lumber, by the way, I will tell you this, the price of softwood lumber rose by 70%, 70, between April and October. Quite remarkable. Copper, steel, aluminum, prices all going up as well. And regulatory fees, 25 cents of every dollar it costs to build a house are regulatory fees. So it does make it very expensive for builders to build homes that can be that are affordable. And because of that, sale prices seem to have plateaued over the course of the last couple of years. You see those modest spikes that we saw over the course of the last couple of years have taken a notch down, but the bottom chart is fascinating. And I say that because if you look at the average sale price of a new construction home relative to a resale home, historically there's always a premium, and the long-term premium here was very significant based upon the fact there aren't that many new homes that are sold. But it has been trending down. That tells me that builders are starting to address the demands of the new marketplace. They are therefore making their new homes more competitive from a pricing standpoint. So they're going to be, in fact, even though there is still a 10% premium, they're going to be looking at the resale market as one of what part of that can they take market share from. When we look at forecasted prices 9.6% this year, I think will increase again significantly, although lower than we have seen for the last several years, about 7.3%. So still a very significant increase. Now, you look at 2019 and wonder what happened there. It's easy. We actually saw mortgage rates rise, and that had a very significant impact on home prices. Now, it rose by a far greater rate than I expect to see this year. So we're still going to do well, and 7.3 is still a very good number, well above the long-term average. Looking out at Arapahoe County, almost similar. Lower amount of inventory. There's next to nothing on the market there, but sales picked up massively last year, and that's interesting. Well above that long-term trend, and actually at historic levels. We've only really broached 4,000 units on a handful of occasions. A lot of demand is going on there. Pricing again, mainly because we've seen that increase from over the course when we came out. I chose 2012, by the way, because that was really the first year we started to see a fairly significant rebound following the bursting of the housing bubble. I've seen a bit of softening there. Year-over-year sale prices, December to December. So again, 1 month does not a year make. Do tend to see there's some fluctuations there. It is softening, but it is still, however, relatively speaking, affordable. Lines crossed. Now, with this top chart, when you look at lines crossing, you can say, well, how can that work? It shouldn't, but it can. And it works because of this. Listings are listings which are taken, the multiple listing service report on the final day of the month. Yet sales are total sales within the month itself. So they can cross. They're just not supposed to. But again, you can see here, massive demand, likely because of the fact lower inventory of existing homes, new construction market is taking advantage of that, and they are therefore selling more. Priced again about $500,000 on average sale price. But look at this here, the bottom chart. We talk about extra demand and what's going on. Well, you look at sale prices, well, they are cheaper in essence than they are for new construction than they are for resale housing. That is a solid, and I expect that again, it's going to be a market we're going to see new construction taking increasing market share. But prices again up last year, softening a bit this year as well. Pretty much it's what I expect. It's a reasonable number to come in, but we've also seen some issues there in terms of some demand factors. But again, I'm looking at existing homes. You can't really put a forecast on new construction homes because that's dependent wholly upon the what the builder builds. So we have to look at the resale housing market. In Denver, low listings, sales going up. Again, it's a very similar picture we're seeing here as we are across the rest of the region, but significant demand. Pricing has softened though, but again, that month-over-month drop you can see here, but we've seen a massive growth, and even 10.3 is a very, very significant number. But here, along with many of the other counties we've already talked about, what I want you to think about is this. For those of you maybe that bought your home in 2012, well, your home has more than doubled. In some respects, it could have tripled in value. And that, I don't know where else you can go to get that kind of return. Well, maybe if you bought shares in Zoom a year ago, you could have done, but other than that, it's highly unlikely. But on the new side, listings are down, still stable supply, haven't met the long-term average. And again, that's more a function. It's a very small new construction market, not really pulling enough permits. So it's not taking that much more in terms of market share. But sales prices of new construction are massive. So huge spike, massive premium because it's a very small marketplace. So we're seeing some very expensive homes. In fact, this price is well above $1 million and have been for quite some time. So expensive housing market. And because of that, we are still going to see that home price growth at, I think, fairly good levels. I actually had to double check this because intuitively it said, well, when you look above $1 million, is it really going to see enough demand? And I think that we will. So we'll still see price growth moderating a little bit, but better than some of the other markets that we have already talked about. Down to Douglas. How can I tell you? Similar, massive demand. Look at that demand spike. Really quite extraordinary. Long-term average about 3,300 units. So we've been well above that, almost to the tune of, just shy of 1,000. So when you look at 2020, a lot of demand and lack of supply, and because of that, price growth has risen significantly. Look at that year-over-year change in in sale price. Very significant. And the market has performed well, but in many of these areas that we've been talking about, we are reaching that affordability ceiling, as I mentioned earlier on. And when you see that at the ceiling, two things come into mind. One of which is we talked about the fact we'll see mortgage rates rise modestly, but more importantly is this: we're not really going to see significant income growth. In fact, I think incomes are going to rise this year by roughly inflation. We'll probably see around 2%. So because of that, ultimately, we are going to have to start seeing some slowdown in prices, in price appreciation. On the new side, demand increasing because of lack of supply. Has been a market that has done very well over the course of the last 3 years. Certainly, I expect to see more new construction activity kicking into place this year. Start to see a notch up, as you can see here, in terms of listings. So if that improves, that's going to be a positive. Prices, again, did see a weird monthly spike. I don't seasonally adjust the numbers, and because it is such a small market, you can see these massive fluctuations. But we're looking at about a 12% price appreciation for new construction over resale. Certainly has dropped down significantly from where we were in 2017, and kind of ranging between 10 and 15% over the course of the last 2 years. So there's a premium there to be had, but there is a lot of demand. But pricing, again, because of where prices are, will soften. 6.6 we saw last year. I'm expecting a number closer to 4% in 2021. Jefferson County. Well, what happened? Look at over 1,600 units on the market in 2012, down to about 180 now. It's a lot. But at the same time, it was a massive drop. At the same time, however, the demand factor is massive. I mean, we're seeing a lot of closings. We're now probably almost over 1,000 units above that long-term average, because, well, prices again have been rising, almost doubled over the course of the last 8 years. Bit of softening there. Year-over-year prices are still up by north of 10%, and a lack of supply. And we're not building enough new homes in this county. That's kind of fascinating to see. Look how low it is relative to historic levels. So we're not seeing that level of supply. If that picks back up, that's going to be a good thing, but it is just not there yet. And because of that, you could say, well, doesn't that mean that existing homes are going to take more share? Well, yeah, look at where we're seeing average sale prices above $1 million in December, in fact, in the month before, and a significant price premium. People are certainly in that market paying more, not just for the house itself, but they are still commanding that premium. And so because of that, we're unlikely to see. The question then becomes, how deep is that demand point? And once you get into 7 figures, that certainly pulls back significantly. So it is a smaller market, but it is an expensive market. Prices rose significantly last year, almost shy of 9%. Expect to see about 4.4% growth in prices this year, above what we saw in 2019, where it wasn't quite as affected as some other markets, but a softening in prices, which I think is a reasonable thing to do. And obviously it's something which you can see across the board. It is almost endemic, and it's applying nationally. We're seeing it in Washington. We're seeing it, quite frankly, across all of Windermere's footprint. Looking now at Larimer County, drop, unfortunately, last year. So we saw a significant drop really starting in the early part of this year. A lot of demand and a lack of supply. That then shows you that we're seeing sales increase fairly significantly this year, above the average, about 4,600 units, just shy of that. But pricing, again, relatively reasonable. We've seen about 10% year-over-year price growth. We're around sales just north of $500,000 in the marketplace at the end of last year. And on the new construction market, on the long-term average, which is about just shy of 900 units, we're seeing that supply level certainly has dropped down over the course of the last year or so, but that, I believe, is actually going to pick up a little bit. So I think we'll see some more economic activity. That means we'll see increasing demand, and that will occur. And sale price, again, there is still a premium, about 5% right now, premium of a new construction over resale. So you saw that drop down, potentially to become more competitive. But I'm expecting prices to rise, and prices will rise. I actually think, well, we saw 8.3% price growth last year, 5.5 this year. So it is performing, I think, quite admirably if you compare it to the nation as a whole and to some of the other markets within our forecast area. And finally, Weld County. Big drop, listings, still significant sales. So there we're looking in pretty good shape. Prices have risen. Again, haven't really quite doubled in that marketplace over the course of the last 5 years. We only went back to 2015 because it's a different MLS system. They did a switch. It was just the more appropriate thing to do. And home prices, and certainly year over year, up by almost 11%. Relatively limited new construction, still demand for new houses, which pulled up, I think, quite dramatically. So I do expect to see more of that. But there is not so much of a price premium for new over resale. It'll be interesting to see how many people move or choose a new home as opposed to an existing home in that area. Historically, it's been about roughly a 10% price differential between new construction and resale. The prices then will come in shy, but very modestly shy of where we were last year. So at 6.4, I think that's a pretty good thing to look at. Ultimately, what do I see in your region? I think that it is a housing market which has done well. Certainly, if you look at it over the course of the last several years, we know that your economy has diversified significantly. You're seeing a lot more businesses come in, certainly energy-based businesses moving into Colorado. And I think that the lifestyle as well is something that's going to attract more companies to move into your area. That is going to be a positive for housing. I think you've got the land. I wish you'd be pulling more permits. Unfortunately, you're not doing that, at least to the degree I'd like to see yet. That is still putting pressure on resales. But at the same time, I think what's important is that from a home seller's perspective, for example, we've been used to some very, very high rates of appreciation. The belief that our own homes are worth a considerable amount of money, and they are certainly. But we are going to get back to a more realistic market, and that's important. But the trouble is that most of us have very short memories, and we do. We think, well, hang on, no. What do you mean that prices aren't going to be going up by 10, 12% per year forever? It doesn't work, and that is just a point of fact. Housing in aggregate and locally has been a very massive positive to the local economy, regionally, and also nationally. It is, some are calling it the super V in terms of the recovery. A lot of people actually thought that wasn't going to happen. They expected the housing market was going to collapse. It didn't, and I certainly don't expect it to do so. We're going to see a lot of demand. You're going to see a lot of demand from first-time buyers. I can't reiterate this enough. They're going to be a major component of the housing market. You've actually seen more people coming in to the metro area, certainly in Denver, than moving out. So you're not seeing that mass migration out, but you will likely see people potentially moving away from some of the job centers if they think they can find a home that is more affordable. It's certainly something we're seeing here in Western Washington, where King County, here where I am, horribly expensive. People are moving out, either north or south, and they are either paying all cash or putting 50, 60% down payments. But again, they're not moving out into the middle of nowhere. They still want to be, in essence, proximate to our job centers. COVID-19 has created an interesting dynamic in the housing market. I think it's going to pull a lot of demand forward. There's no doubt about that. That is going to come from those first-time buyers, potentially even more so, as I mentioned earlier, because of the first-time buyer tax credit. I think also people are going to look at their homes realizing that they are going to be working from home semi-permanently, for example. And again, that's that couple of days a week here and a couple of days a week in the office. And many of them may realize that they don't have a dedicated workspace. I mean, I'm one of them. I have been working from my dining room table since the 13th of March last year. I'm not going to move, but I think a lot of people will. And they'll do it in order to have a dedicated space. Now, for those people that are saying, well, I want to move, but I don't have that dedicated workspace, so perhaps my home won't be as competitive. Well, that can be the case, but we're actually, amazingly enough, seeing people, even if they don't have per se an office, creating dedicated Zoom spaces within their homes. That's an interesting concept. I will tell you something else. As Eric mentioned, I do get interviewed on television a lot. I have done more television interviews with reporters calling me or speaking to me either from their cars or from their bedroom closets than anywhere else. Very, very unique. So because the work from home scenario, again, it's not going to be temporary. It's not going to go away. A lot of people, where they are able to, will be working from home, but more than likely most of them part-time. And in essence, the reason for that is that we miss that symbiosis of discussions around the water cooler. And I think productivity issues can be in place, even though we have Zoom. But productivity is interesting as well. Why? Well, my example is always, if I was in my office and maybe one of our co-presidents, let's say Obi Jacoby, wants to ask me a question, well, he'll come to my office door, ask it, and walk away 3 minutes later. Well, that 3-minute telephone conversation one-on-one has turned into a 30-minute Zoom call. And that can lower productivity. And from an employee perspective, training is an issue online as well. So I really do expect to see that split between our homes and our offices. I also think, again, I mentioned earlier, people will get bored with what they've got. They'll look around and say, I just want to move because. It's sad, it's somewhat unusual, but I do expect to see that. So we are going to see, I think, greater turnover, and turnover being the sale of existing housing. I am hopeful we'll see more permit activity occurring. We know that costs are very high for builders, but as some of them look at either some of those secondary neighborhoods or even secondary markets because of lower price and greater availability of land, we'll probably see more activity in that market too as well. So that all these things in concert, I think, will take some of the price pressures off the existing housing inventory. We'll see more turnover. I expect sales to be up in your area across the board, as they are going to be across the country. I'm very pleased that we are, as a company in the Western United States, we're still performing very admirably, not just from an economic recovery standpoint, but also from a housing standpoint. Now, we are still seeing foreclosure rates very high in markets or states like Louisiana, Alabama, New York. But where are some of the lowest? In Colorado, in Idaho, in Washington State as well. So we're seeing really a bifurcation in that respect. Home prices will rise this year. I expect mortgage rates, however, are going to slowly trend up, but 4% mortgages are, I would argue, a 2022 story at the earliest. Higher than we've seen, but I certainly don't see them going down any further. Demand's going to be there. Demand not just from first-time buyers, but demand from people who are going to look to move further out into a different home that more satisfies their needs. And the housing market, finally, I guess I'd say, is that there are still people out there who are hoping that we are on the cusp of the bursting of another housing bubble. I just don't see it, and I really don't. Why? Well, qualifying is still remarkably hard. Yes, prices have gone up by above average rates, but they are going to trend down because, in essence, there must always be a relationship between home prices and incomes. Now, we've offset that because mortgage rates dropped by 1 percentage point last year. If they don't drop any further, they start to notch up a bit, and we don't see that income growth. Again, it really says to me a slowing down in growth, not turning negative. And I'm afraid that the naysayers out there who believe the housing market's going to crash again, most of them, by the way, because they can't afford to buy a home, well, yet again, for another year, they're going to be wrong. I hope that you found interest in my comments today. I know we had a lot to get through, and thankful for you being so patient with an old English guy who tends to speak way too quickly. But I think I will close with this. We went through a health crisis, not a housing crisis. Housing and the economy was performing very, very well back in January and in February. We turned the economic lights out, not just because of the normal reasons we enter a recession, but because of a bug. And so because of that, as we start seeing that recovery, yes, it's a bifurcated one and more improvement coming in the second half. It's also the recovery is somewhat K-shaped. Now, what do I mean by that? I think businesses or employees that are able to work from home, I don't know anyone that lost their jobs because of COVID-19. And so we've done well. Yet, however, those face-to-face industries, yes, leisure and hospitality, significantly impacted because of declines in employment in bars, in restaurants, and in hotels. But we have not seen that elsewhere. And so the K-shape being is that the haves, who do tend to be, by the way, home owners as opposed to renters, are doing very well. The have-nots, those in those service industries, have been suffering. Again, most of them are renters. They are still having a very hard time. I feel very sorry for them. But at the end of the day, the ownership housing market is going to do well. I expect to see the rental market, I'm afraid this year is going to be a tough one for them in many parts of the country because of the moratoria on evictions that's in place, at least right now. So at that point, I know we're going to get into questions, but I know that I believe that Eric wanted to bring this up. Eric, do you want me to turn it across to you?
Yes, thank you so much, Matthew, and thank you for an amazing presentation. We will take questions. We have time blocked out for questions.
Yeah.
However, just in case people need to cut out at some point over the next half hour, I want to make sure that everyone is aware of our next workshop. So we are big believers, obviously, in educating our clients, in clarifying things to them, clarifying the market, clarifying also opportunities. So there is an opportunity for you to own real estate inside of an IRA. This is not a brand new thing. This is something that's been around for a long time. I personally own 2 investment properties inside of my IRA. And what we find is a lot of people just aren't aware that this is even an option. Some people may have heard of it, but they're not sure how it works. So we're going to clarify all of that for you. January 28th from 10 to 11. This is a workshop for our clients and friends. So the way to get signed up, this course is complimentary, is go to windermereworkshop.com to get signed up, to either, just like today, to watch live or watch the recording. We're going to have First Bank join us on that presentation. They are the experts in terms of how to create loans for these kinds of properties, these kinds of investments. We also plan to have representatives from New Direction IRA. They are the custodian for these types of investments, just like Charles Schwab is your custodian for your mutual fund. New Direction IRA is your custodian for your real estate inside of the IRA. So long story short, get signed up, windermereworkshop.com. It's an amazing opportunity to own investment real estate if you want to diversify out of the stock market. It's your chance to explore doing that. Get signed up. January 28th, that's a Thursday, from 10 to 11. Okay, my friend Matthew, let's do some Q&A.
Bring it on.
And again, as always, just so insightful, so many takeaways. I appreciate your ability to make seemingly complex issues come across simple. I want to start with, if it's okay with you, we got to go back to this bubble question, because we hear it a lot. I'm guessing you hear it a lot. People look at the market and they say, how on earth can prices be at this level, appreciate at this level for at this percent for this many years in a row? Prices must crash. They've got to come crashing down. There's got to be a bubble. We get that a lot. You get that a lot. I want to tell you about a metaphor that we use. I want to see if it works for you, and then I want to get into a little bit more about the reasons why. The metaphor I like is it's just like going upstairs. So it's like running up a flight of stairs. You know, if you're going to run up a flight of stairs, eventually what happens? You get tired, right? You get really tired if you're going to run upstairs. So eventually you have to start walking. So kind of what I'm seeing from you, what I'm hearing from you, Matthew, is that we're going to stop running or sprinting up the stairs. We're going to start walking up the stairs, but we're still going up, all right? So the market is still appreciating, but the pace of appreciation will slow down closer to what we're seeing over the long term. And what I always think about it is supply and demand, right? So simple economic prices can't crash if we have inventory, in some cases, a tenth of what it was back 8, 9, 10 years ago, right? So can you just expand on the bubble? Pretend you're in front of someone who has big concerns about prices must crash.
Sure.
How do you answer them? Please expand on that.
Sure. Well, it's really actually rather simple, although what you're saying, Eric, and your analogies are very accurate. Now, going back, remembering the bursting of the housing bubble, it burst, obviously, we all know why, rampant speculation, people flipping homes left, right, and center, and quite frankly, my dog qualifying for a mortgage. So everyone did. So we saw that crash. So what happens is that we actually overcorrected. And so we went from very, very high prices to prices which actually were not just good, but we were very, very cheap. And when we saw that, as we started to come out of that bubble, and it really started in roughly 2012, you could see that massive price growth because housing was cheap. And so we could see those years of double-digit price growth there just to get back up to where we were. That said, we certainly have done it, but there's a major difference why we're not in a bubble now. And it's because of banks, and it's because of lenders. They have become, or they became, significantly more conservative in their underwriting. To give you an idea of what was going on there, is that the average FICO score, credit score, and on an approved conventional mortgage last month was just shy of 750. So we are very qualified to buy our homes, point one. Point two is we're putting down significantly higher down payments than we did before. Point three, the utilization of ARMs. Back in 2005, 1 in 3 mortgages was an ARM. A teaser rates, liar loan, whatever you want to call it. And those, what it is that people took them so they could qualify. Then all of a sudden those rates reset, and we know what happened. No, I mean, right now we've got adjustable rate mortgages last month were less than 3% of all mortgages, and they dropped down massively. So qualifying is more stringent than it was. Again, no bubble. Down payment significantly higher. Again, no bubble. So when we talk about it has to crash, no, what you said is right. It has to moderate because this is a class I teach at the University of Washington, which basically says there must be a relationship between incomes and home prices. We broke that relationship for the better part, and we continue to break it through this year because mortgage rates dropped because of the pandemic. Now, they're not going to go down any further, but with mortgage rates dropping, that allowed prices to continue to appreciate at those above average rates. But that cannot go on forever. I hate it, and I hate any market where it does, because that scares me. But any suggestion that of being a bubble, no, we've got that demographic demand that you mentioned. We've got a lack of supply. We are all of us living in our homes now for twice as long as we used to, which is really a quite remarkable thing to say. So we're not moving for our jobs as frequently. New construction has not kept up because banks were very cautious on lending money to builders. So we've got this demographic demand, we've got these new households being created, but it is forming an affordability issue. And because of that, and because rates aren't going to drop further, I expect that to cause prices to slow, at least price growth to slow down. But any thought that we'd see the kind of 30+% drop in values that we saw when the housing bubble burst, just not going to happen. If it did, believe me, Eric, you know me, I would be screaming it from the rooftops. But it's just not there. It's a very, very different paradigm today than we were in back, well, now 12 years ago now.
Yeah, 12 years ago, we had, the reality is we had a glut of inventory. A lot of that was new construction. So just to put this in perspective, in 2007, there were over 30,000 homes on the market in Metro Denver. Today, there are less than 3,000. So in a very short time span, there's it's a tenth of the inventory. Right. Same dynamic as well in Northern Colorado and Larimer and Weld County. So with demand that as high as it is and prices, or I'm sorry, supply is low as it is, it's like physically impossible for prices doing it.
And you're right, we saw that massive glut of new construction, but at the same time also almost carrying on through that, we started seeing a massive increase in foreclosures. So that wave of existing supply came online in concert with mass amount of new construction. So again, go back to Econ 501. Too much supply with a finite amount of demand, that impacts prices. And that is where we were, but that is certainly not where we are today. It's a very different situation, and it's one that is not going to be repeated. And I will forever be thankful to a gentleman, Senator Barney Frank, come up with the Dodd-Frank bill, legislation back post-housing bubble, which in essence made it a lot harder for mortgage companies to lend money to anyone with a heartbeat. So that came into play. Solid demand. There can be a lot of demand. Again, those are our agents out there. If you're not working with first-time buyers, figure it out. They're going to be a very, very large component as they move out of these apartments into ownership housing. They're also getting into real relationships. And so they are getting married. They are thinking about having children. They're going to go out, move out of those urban apartments, and they're going to become home buyers. And that could happen even quicker because of work from home. So that is a demand sector which hasn't peaked yet. And it'll be up there for several years. And let's not forget about even Gen Z. No one's talking about these guys yet. They're in high school, going into college. There's a lot of those guys out as well. So the demand's going to be there. Supply isn't. Housing inventory is very low. Our qualifying, we are remarkably overqualified to buy homes. Again, it just says that price growth, the pace will slow, but certainly not turn negative. At least not in your market. I will just add on one thing. Do I expect to see prices turn negative in some markets? Yeah, but where are they going to be? One, a specific product type, condominiums. Two, where? One, Manhattan. Two, San Francisco. And those are markets which are suffering already dramatically. And so not all markets are created equal. And I do expect some of these urban condo markets where we saw a lot of new construction, as we did in Manhattan and also in San Francisco, those going to be hard markets for that area and that asset type.
Exactly. That's super helpful, Matthew. So let's get to some questions that were typed in.
Sure.
So here's one. Why were Colorado's annual price changes so much higher around 2015 than they were in 2020? So that's a question.
Sale prices.
Home price appreciation.
Appreciation, right? Yeah. And again, I thought I obviously didn't explain it well enough. That was, think about it again. As we came out of the bursting housing bubble, we went from housing which was remarkably, in essence, I say affordable, cheap. And what happens is when you overcorrect, when you see a change in any marketplace, and certainly the housing bubble bursting is a good example of that. You always overcorrect, and the same thing applies to the economy and jobs as it does to housing. So we saw a massive overcorrection. A lot of that was because of foreclosed homes, when banks, all they really wanted was to get the money they were owed out of it. So we saw homes be very, very cheap. And because of that, through those years, and really coming out, starting in, depending on where you are, 2011, 2012, we saw that big ramp up in prices because of the fact they were relatively speaking cheap. And at the same time, we also had the first-time buyer tax credit, which came into play there as well. And so there's several things which came into play which suggest, or which demonstrate the fact that prices rose by well above average rates because it was cheap, and a lot of people the belief in the housing market had returned. A lot of people had been thinking up until that point, we were all going to be renters. Buying a home was just a silly thing to do. Well, depending on where you are in the country, that shifted over time, as it does. We started seeing a lot of demand, started seeing prices rise dramatically because we overcorrected on the downside.
Got it. Super helpful, Matthew. Thank you so much. Here's a question. This is from a realtor. It says, with growing demand coming from the younger demographics, first-time buyers, et cetera, what will ultimately cause inventory to start to move up again and help with the supply side of this supply demand equation that's really out of whack right now?
Yeah.
And he adds, one thing that's happening is that a lot of people right now aren't listing because they don't think there's anything else out there for them to buy. So it becomes kind of this cycle.
Yeah.
So give us your take on that.
Sure. And it's very classic, and it really becomes a chicken and egg situation, is my version of what you just said. As in, I'm not going to list my home for sale if I can't find somewhere to buy, and if I can't find somewhere to buy, I'm not going to list my home for sale. Absolutely. Two things going to happen. One, you're going to start seeing increasing levels of new construction. That's going to be a positive. That's going to be more supply there. Secondly, we are going to see more turnover of homes because of the ability to work from home. Again, as I mentioned earlier, a lot of people's homes they're in right now just aren't conducive to work from home. They're going to move. Other people, by the way, this doesn't apply to moving homes. It applies to, believe it or not, I think when the numbers come out, we'll see the number of divorces increase in 2020. Why? Because we're around each other too much, but we're around our homes too much, and we get bored, and therefore we start nitpicking. So a combination of I can move further out because of my job or not, there's less of a necessity to be close to where I work. 2, perhaps my home doesn't meet my needs for work from home. 3, moving because we're bored and we're just bored with the home we're in. So that's going to increase the turnover. I expect to see new construction add to inventory as well. And certainly on the new construction standpoint, builders have become already very cognizant of what a home buyer demands now. And what that means is we're going to see more of those formal office spaces, which quite frankly we haven't seen in 20 years. We're also going to see houses get bigger. In fact, the last several years, the average new construction single family home has contracted in size. That changed last summer. So we're going to see homes get bigger because of more space. Also, the open plan concept, which was the thing for everyone to do, no, now people want room separation again. So builders are going to adjust accordingly. I expect to see more supply of new homes. That turnover is going to happen because of all the reasons that I've mentioned. And so because of that, both on the new construction and on the resale side, I expect to see more transactions occurring.
Okay, got it. Thank you. Here's another good question. It says, can Matthew speak on the relationship between the consumer price index, CPI, and housing prices? So is there a correlation? Is there a relationship? Can you speak to that? That's kind of a economic 601 question, right?
That's okay. So CPI, consumer price index, in essence, it's how we calculate inflation. Housing costs, by the way, are a subcomponent of CPI. So housing costs actually get built into CPI along with groceries costs and these kinds of things. There really isn't a relationship there. Yeah, if you want to look at the best way of looking at a relationship as it would pertain to home prices would be to look at mortgage rates. Now, mortgage rates, certainly 30-year fixed mortgage rates, they always track the yield, the interest rate on 10-year treasuries. And there's always a spread between the two numbers. The reason why there's a difference is because there's always a risk premium associated with the mortgage over a bond. Bond has no risk, we know that. So, and they always work in lockstep with each other. We broke that relationship back in February. Why? Because of COVID-19. And also because of the fact when COVID-19 hit, move away from equities into bonds, that meant the bond price rose, the bond yield, the interest rate dropped, mortgage rates dropped. And by the way, the reason why 30-year interest rates track yields on 10-year treasuries is that we tend to move or refinance every 10 years. So that's why that works. So there's that relationship, and that's how we can look at where we get moving in terms of bond yields. That explains mortgage rates and the potential direction of them, as I showed on my slide earlier. So CPI housing and shelter costs are a component of CPI, but there is not a blend, because if there was, then home prices would be going up by an average of 2%. So it really isn't, but they are a component of inflation. And so they are built into the numbers, but there's no direct correlation between CPI and home prices.
I just felt like I was just transported to your course at the University of Washington that you teach back in economics in college. Okay, one housekeeping point, beginning a question about the recording. Yes, even those of you who join live will get the recording. GoToWebinar is automatically set up. We've set this up where you'll automatically get an email just in a little bit with the recording. So that's there to help you out.
I will also add on one thing, and that is that I will be sending my slide deck to you, Eric, to distribute to anyone that would like it. So and perhaps there'll be a few people that want to pore through the numbers a bit more. Great bedtime reading, by the way. I'll send you to sleep in 2 minutes.
Absolutely. We appreciate that. So you can just use your Windermere Realtor to access that. We'll get the slideshow out to our broker team. And if you would like the actual slide deck, to see a PDF of that, just connect with any of our Windermere realtors. Be happy to help you with that. Here's a really good question. What do you think of the single-family rental market as an investment opportunity? If interest rates stay low and more people purchase, does that mean softer rental demand? I have a take on that too, and I of course would appreciate your take.
You can go first if you want.
Okay. Well, what I would tell you is that when we look at the numbers, we don't see the rental market softening. We see rental rates flattening. We see vacancy rates flattening, but we don't see anything like rental rates coming down, vacancy rates jumping up. Vacancy rates along the Front Range are generally around 5%, which are quite low. And the advantage for the investor today with rates where they are is it sure looks makes those monthly cash flow numbers much more attractive. I mean, it's an incredible opportunity right now for investors. We're working with a lot of investors right now who understand the advantage of these low rates. The challenge, of course, is inventory and finding those kind of properties, because single-family investors tend to want properties under 400, under 450. Harder to find, not impossible, harder to find. But it's really more, the challenge there is not so much what the numbers look like. It's on finding the property. So tell me what you think, Matthew.
I mean, beyond everything you said, which I think is very accurate, and expanding on one of those points, you mentioned price point, and that's true. Because what is important from a single family rental standpoint is I can pay whatever for a house, but what rent has to be achieved to service that debt? And so that's when you start getting to some of the more expensive markets. It can just not make sense. Now, we all have also seen, I'm not sure it's applicable in your market, a moratoria on evictions. You can't throw people out. So is that in place where you are or not?
It is, yep.
Okay. And so clearly there are concerns in that respect as well. Now, a lot of people are saying, well, aren't all those single family owners of homes that are now not getting any revenue in because of the moratorium on evictions, aren't they going to go into foreclosure? Well, depending on how they financed it, you can still get forbearance if you finance through one of the GSEs on a non-single, or non-primary residence. So hopefully there will be some people that have entered that program. That means again a lower rate of foreclosures. But the big question is always going to be the fact, the moratoria on evictions, and how long will that continue? And so the concern is twofold. One, we've seen prices go up. Depending on what you're looking for, it might actually preclude you from buying an investment home just because the rent you would need to get is above the debt service. So debt service rather is higher than the rent you can achieve. But in all, I think I always tend to look at housing, ownership housing, on a longer basis, and not just on a month-to-month. We know apartment developers and apartment owners of these big buildings, they're going to hemorrhage cash this year. That's going to have an impact. It's going to obviously hit the real estate investment trusts and the investors in those. But the single-family market, rental market, is different. And if I look over the longer term, we're going to see that moratoria end. We're going to see jobs continue to return. So as long as you believe that you can get an adequate amount of rent for the house you're trying to buy, secondly, good luck finding one that meets that criteria, then I look at the longer term. And the longer term is that the housing market is going to continue to increase in value, and at lower rates. But again, if you look at where financing costs are right now, we are unlikely to ever see mortgage rates where we saw them even last week, week before last, they hit an all-time low again on the 30-year. That's the 17th time they've broken through all-time lows since March. So it's really extraordinary. So that's a positive. I'm not particularly worried about it, but the one concern is obviously the moratorium on evictions and how long that could continue.
Got it. Thank you for that. Here's a really good question. Does Matthew have any thoughts on when more information will come out on that first-time buyer credit that you mentioned?
Yeah. Yeah, well, that's part of the new incoming Biden administration's plan. Obviously, let's get through the 20th first. I think it'd be an appropriate thing to say. There's a lot of very bold plans, and certainly the new administration has some very significant plans when it comes to housing in general. Big focus on low-income housing, however. both low income and Section 8 housing, and expanding funding for that. The first time buyer tax credit, this is not new. We saw it coming out of the bursting of the housing bubble, but we also saw it under both the Bush administration and the Clinton administration. The difference here is very significant. It's not just you can take that money off your taxes, it's real money. And so that makes it a very different scenario. The one concern I have, however, even though the Georgia elections went the way they went, and therefore now Democrats control the Senate, is the fact that Republicans, and this is said with the greatest respect, who historically have been fiscal conservatives. The last 4 years, as they've obviously had control of government, they've been spending money like drunk sailors on shore leave. And they really have. I mean, massive spending means a national debt now, $24 trillion. The budget deficit is now at levels we haven't seen since World War II. And so my worry is that are they going to turn now to become all of a sudden really worried about balancing the budget and about becoming a fiscal conservative again? That can impact that. So in terms of more details, it is still a plan. It's still on the new Biden agenda. There are no more details yet. I'm hoping those will occur once we get the new administration up and running. But it is something that I hope will succeed. It is very important, and we know just purely the number of first-time potential home buyers out there, that could cause a flood of new demand. And then it comes to the fact of where can they afford to buy. It's all great saying it's going to be wonderful in Ohio, where home prices have gone up by 1% for the last 60 years, but very different in other markets, and certainly yours, certainly, quite frankly, in most of the Western United States. So there aren't any details yet. Keep an eye, however, on announcements from the new administration, because it is one of their major plans that they've been working on.
Great. Okay, Matthew, let's do a couple more. So, question: why are banks? Whoops! Someone just typed a question right as I was reading that one, so that just popped the question off my screen. Here we go. Why are banks less enthusiastic about foreclosing now compared to 2009? Mm-hmm. What lessons, as you said, did they learn?
Well, those are lessons. I think that in certainly, I've given a handful of speeches already to mortgage companies and to banks, and I'll be doing a lot more going forward. And the impression I'm getting from them and the discussions I've been having with them is that they don't want to go through what they had to go through back in 2009. It's painful. We certainly know because of Dodd-Frank that their underwriting is a lot harder. They just don't want to have to own real estate. It's not what they're in, why they're there. And so I think that everyone I've spoken to has been saying, without a doubt, there are going to be some problems going forward. But the mentality now is very, very different from that we saw back when they were lending money hand over fist to anyone. The old ninja loans, no income, no job or assets, were rife. And they really are in a position now whereby they're going to try and make it work. And certainly because of part of it is because of forbearance. And no, they entered the program. Some private independent banks didn't have to, they weren't forced to. This is a program put in place by the FHFA back in March. So that could actually well be extended further. But they're going to work to try and do two things: either extend the term of the loan in order to make those payments back up by increasing your monthly payment, or by refinancing into a new product. So ultimately, every banker I've been speaking to is saying, yeah, we've learned a lot. We are going to work more with these clients. We understand what happened. We understand for many of them, if not all, it wasn't their fault that they were put on furlough or laid off. It's not a case they were borrowing money irresponsibly, not the case. And but more importantly than that, those people that can't make it aren't going to go into foreclosure. They are still sat on a lot of equity, irrespective of when they bought the home. They're going to sell into a market where there is still very significant demand to release that equity and then hopefully start again and not go through the painfulness there is on foreclosure, not just going through it, but also that it precludes you from buying another house for quite some time. So every banker has been just remarkably pleasant about this and saying, yeah, we're going to do our best to do these things. They were hurt before. Why? Because of forbearance. What that really means is that these banks, these companies, even though you weren't paying rent to them, they still had to pay the bondholders. was costing them billions of dollars almost on a daily basis. That scared them a lot. That has now started to get a lot better. And everyone I've been speaking to has been saying that, yeah, we are going to see some issues, but overall, we are going to work with homeowners to try and keep them in their house where possible.
Okay. Matthew, last one. Yeah, I think this is a good one to finish on. Top markets. So in your mind, in the Western US,
yeah,
what are what markets come to mind for upside? What markets come to mind for downside? And let's end on a high note. So how about you do downside first? So which markets in the Western US, maybe another way to say it, or do you see are at risk of maybe pricing's going down, and then which markets in the Western US have the biggest upside? We'll finish with upside.
Okay. Down in aggregate, it's going to be California, Northern California specifically. We're seeing a mass migration out of California, not just in Northern California for several reasons. One, it's house prices, point one, tax situation, another one, but climate, forest fires are impacting people in those markets, that state rather. Also, their economy is going to improve this year, but it's still, the growth is going to be fairly modest. So we are seeing a move out of California. A lot are coming up I-5, one or two are staying in Oregon. Most are smart and they keep on going. They come up to Washington and into Seattle. So I think that Northern California, certainly if you look at San Francisco, is one. At the same time, however, I would say that I expect the luxury market in Southern California, in San Diego, to perform very well. It's a market I'm looking at that I think is going to do very well. There's a handful of luxury markets which are going to perform. The other one's going to be obviously the Hamptons, which doesn't really go down. Miami because of home buyers moving out of New York, where they've seen some fairly significant changes to income taxes and moving into Florida. So I think low part is going to be Northern California. I think the rest of the Western United States is going to do well in terms of, or at least relatively speaking, if we look at all markets. I mean, I think they could probably say New Mexico, but very, very small market. Texas as well is softening, again, predominantly because of energy and oil and those kinds of things. So that's Western US on the downside. On the upside, I expect to see Colorado do well. I think it is going to be, in terms of a softer price growth we have seen, given all my forecasts, and I am fine with that. I think your economy is recovering better than many markets, better than we see in Oregon, not quite as good as we see here in Western Washington, but that's a good thing. I think Utah as well is another market which is going to do well, and certainly around the Salt Lake City area. I also see the destination, the vacation markets do well. Second homes are something else which people, including myself, I admit, back in March when I started giving kind of Zoom speeches to our offices across the network, I was saying, guys, it's going to be very rough for those areas. I was wrong, and I was wrong for a couple of reasons. And an example I'll give you is that we have a handful of offices in Montana. This summer, they had more second home buyers coming in from Los Angeles and New York than they have ever seen before. Because I think it's quite likely we'll see a lot of people move away permanently, potentially, from the traditional hotel-based vacations and into second homes. Given the fact where mortgage rates are right now, even with second homes, it can, for a lot of people, be a smart move. Now, the one thing I will tell you about Montana, I just want to see a Los Angelian survive a Bozeman winter. That'll be interesting to see. So I think second homes and therefore these vacation markets will perform. I think recreational and resort markets like you have in Colorado, I think they're going to do well as well. So the upside here in Washington, and certainly Western Washington, in the central Puget Sound region will, however, King County, where I am, is going to already start seeing that move out because of affordability. However, at the same time, a lot of tech companies, they are here. They're not going to go anywhere. They're not going to move. But we are seeing some major affordability concerns. So I would say that your market, certainly both around Denver and in northern Colorado as well, will outperform. I think Utah will. I think Western Washington will outperform as well. And I think really the Western US in general will do far better than the central part of the country. Increasingly, I would add, and finally, is that concerns over climate change are something now which are becoming more front and center in people's thought patterns than we've ever seen before. And that again is driving a lot of people out of California. It will ultimately mean more people coming out of Louisiana, parts of Georgia, also on the eastern seaboard as well. They're going to come into the center part of the country. So, and the last market I'd say I am excited about is Boise, Idaho. Relatively speaking, affordable. You can buy a brand new, never lived in single family home for less than $350,000. Their economy has almost recovered all the jobs that were lost. And downtown, which used to be, quite frankly, a place you didn't want to go to, is now kind of cool. It kind of reminds me of the gas lamp district in Southern California, San Diego. So I think that's a market which is going to be good. So I also think that around Denver is good because of economic growth. I think you have the land, just need to build more on it. You've got a wonderful airport. It always annoys me as to where it is as opposed to what it is. It looks great. Getting there is never always seems to take me a year and a day. But the ability for companies to grow, are they going to be looking at Colorado, around Denver, around Fort Collins potentially as well? Yeah, as expansion markets because of relative affordability. So you are one of them. I would say you are better off as opposed to really, I think the one West Coast market that is not going to do well in recovery is going to be California.
Got it. Matthew, once again, you have over-delivered. We are so grateful for you. You're such a great asset for our company and all of our clients. We so appreciate your time, all the energy that went into the creation of this presentation and everything that you delivered during the presentation. We are so happy about that, so grateful. Thank you so much. We're also grateful to all of you who tuned in, who engaged with this presentation. You watched live, you watched the recording. Again, we had hundreds and hundreds and hundreds of people sign up for this. 3 things that you need to know about. Number 1 is on your screen. Get signed up for the Windermere workshop. It's all about how to buy investment real estate with your IRA. Really easy. It's January 28th. Yes, you can also watch the recording. In either case, live or the recording, sign up at that website, windermereworkshop.com. Number 2, make sure that you're getting this newsletter, the Windermere Report, that we produce this every single month. That has great insights and stats and facts and trends, things like all the things that you saw here today from Matthew. Your Windermere Realtor can connect you with this monthly newsletter. Number 3, your Windermere Realtor can help you show the value of your home today. Even if you're not thinking about selling, you're seeing all these numbers, all these stats, you're hearing about where prices have done. You might be curious, what is my home worth today? We're happy to show you, even again, if you're not interested in selling your home anytime soon, we can put together a snapshot for you. We do it all the time. We're happy to do it. Just reach out to your Windermere Realtor. They would be more than happy to produce that for you and get that into your hands. With that, I'm going to say goodbye. I'm going to say thank you so much for being a part of this. Matthew, thank you once again.
Eric, a great pleasure. Hopefully, this time next year, we'll be back to normal and I'll be seeing you all in person in Denver and Fort Collins again.
Indeed, that's a perfect way to close. You know what? Let's all have a vision that a year from now, we're back together. We're together at the Wilshire Inn in Denver. We're together at the Fort Collins Marriott, hundreds of us in the same room, you know, all that great energy and collaboration.
I can't wait.
We're going to have our fingers crossed. We hope for that. So Matthew, thank you again. All of you who watched, thank you again. It means the world to us. We'll see you all really soon. Stay happy, healthy, and safe. And thanks for watching. See you soon.
Stay safe, everyone. Take care.